about Richard Wyckoff or about Tom or Gavin or Trey Guider. So I think we're just going to cut to the chase, which is what it's about, and we're going to get on with it. Now, many of you, who's new here? Because there's a couple who are brand new. So you're new, and so that's 3. So for the rest of you, I'm sure that repetition is not such an ugly thing, but for those 3 who are new, probably may not understand or have a concept of the principles perhaps as the rest of us. So, for the 3 new guys and for anybody who doesn't mind a bit of repetition, I'm going to go over the principles. So, the only bit of reading I'll be doing is for these principles, because even though I know them, I like to read from Tom's actual writing itself when it's actually describing the principles, because I think he does a great job of doing it. Now, somebody's asked me before I just start about this being a no demand bar, but you cannot really read into this bar because you don't know what's in the background. Okay, so yes, there probably is weakness in the background, but when you see a bottom reversal such as this, okay, that's a sign of strength, and that's the number 1. So basically, it's a wide spread down plus closing on the low, which it does. This one just off the low, and then the close is lower than the previous 4 bars. Okay, so 1, 2, 3, 4. So if you've got a wide spread down, it's lower. The close is lower than the low of these 4 bars. Okay, then that brings it to life, and you've got to have that. Okay, so it's got to be lower than these 4. Okay, so followed by an up bar on a wide spread plus closing on the highs, which this one almost is. And this will arrive in a variety of versions, but basically the first down bar, that's to shake you all out. You can see that the volume is much higher than the volume bars in the background just here. Okay, so it's got a wide spread down. Obviously you can see that there are stop loss call, perhaps margin calls. This is pound against the dollar on a 2-hour chart, so there'll be many, many thousands of stocks. Now the next bar is up, so that's a bottom reversal. Okay, so the first bar is a shakeout, usually on so-called bad news. Okay, or it can also happen right at the start of the trading session, so that the desk traders, the professional traders, want to shake as many people out as they can, and in order to remove possibly the floating supply from higher prices if they're bullish. Okay, so they'll ram it down to catch out stops, take as many traders out of the market as possible, so that when the market starts to go up, then there won't be any supply at a higher level to put a cap on those rising prices. Can you still hear me? Because I can't hear myself from the speaker now. Okay. Okay. So, okay. The other thing is to prevent people from going in, because of the rapid markdown. It's to lock you out. Okay. So it's to lock you in if you're short, and it's to lock you out if you're thinking about going long. Okay. But what follows on is probably just as important as the principle itself, because as the market then goes up, you can see the volume is still quite high, and they start to close off the highs, okay? And this one's a bar close in the middle. Okay, so then you have a down bar close in the middle, and the volume's still quite high, okay? So rapid shakeout, bottom reversal, the market goes up 2 bars, the volume's still quite high, so we'd be skeptical of the up move because you've got quite high volume on up bars, and the market doesn't like that, okay? Markets do not like high volume on up bars, okay? So if you see that, to follow that, you know that it's not going to go up straight away. So then we have a down bar closed in the middle. Volume's still quite high. There's a lot of supply around. A lot of panic traders there. Possibly shorts from back here, closing out at a loss, possibly. Down bar, closed in the middle. Volume's still quite high. Now, we've got a down bar, and it looks to me as though the close is probably a little bit lower or perhaps equal to the close of the previous bar. Volume's still quite high, but what this tells us is that the market's probably not going to go down, okay? But because we've got higher lows up to this point, and then we got higher lows, we say that the trend is up, okay? So that's a strong bar, even though the volume's quite high. It starts to go up on low volume, okay, and then another principle is kicked into place because we've got, just come over here. We've got up bars, okay, on low volume into now a previous top where there is quite high volume. Okay, so that tells us that we're not really looking at higher prices simply because we can't penetrate an old top on low volume. Okay? So if we've got low volume on up bars, such as we have here, although it looks as though we've got a test light bar here, we are in an uptrend. Okay, so it's probably not going to get above that high at the moment. The volume's far too high. There's too much supply in the market. Okay, so any questions on that? I encourage you to ask as many questions as possible, John.
3 bars from the right.
3 bars from the right? Yeah.
Could you call that a hidden test?
This one? Mm-hmm. No, because that's got a top tail. Well, if you take the close, the body of the bar is greater than the close of the previous bar, not lower. If it were lower, then yeah, you could say that was a test bar. But it's an up bar, not a down bar. Okay? That's more likely to be a test than that. That to me is a low volume up bar. It tells me the market's not going to go up very far.
So for a test or a hidden test, you're looking for the body of the bar
to be lower than the close.
Yeah,
it's got to be down here. Yeah. It can close as an up bar, according to Wyckoff, because there are 9 tests. But it can start down and then end up as an up bar. We'll probably show you one of those later anyway, because there's bound to be 1 or 2 in the charts that follow. But yeah, that's just a low volume up bar, and you've got another one. So approaching this old top, John, what that means is that you've got quite high volume. There's a lot of supply there. It's knocked it off the top, off the high. And then you've got 2 low volume up bars into that. It can't go up. So there's an effort to shake the market out for higher prices. But because there's so much supply at this level up here, that it's just probably going to fizzle out and go sideways. Yep.
I was thinking for the 2 bars in there that kind of distract me, I guess is the word to use, is this 3rd bar from the left, or from the right, which isolated by itself, yes, is a no demand bar.
Yeah.
Taken with the immediate weakness in the back of it.
There, yeah.
Yes, and then back before, which we don't know, further to the left.
You're talking about that one? Yeah.
In and of itself is another no demand bar.
Well,
so if you isolate those, it's riddled with weakness.
But you can't isolate.
In spite of the strength in there, and that's what distracts me and gets me, sometimes throws me off track.
But you can't isolate bars, that's the whole point. It's like a jigsaw puzzle. You've got to put all the pieces together to see the overall picture. See, so you can't say that's a no demand bar. It probably is weakness behind, because otherwise why would you have that? You see, if that was probably not weakness, then you wouldn't need that. But because you've got that, there must be weakness in the background somewhere. So you probably are quite right. But it's going up on low volume, but it's also going down on low volume. We don't know what that is. That could be a test as well. We don't know. But got down bar, low volume, up bar, 2 up bars, low volume, then you've got a shakeout. So yeah, it probably was weak behind. But obviously if you can't see it. But if you've got, this is an effort, okay, to shake the market out. So you've got to see what the result of that effort is. But the effort is there's just too much supply at higher prices. It's not going to go anywhere. Especially when you've got 2 low volume up bars into a previous top where there is high volume. It's not going to get up there.
Where would you take your position on the, let's say, on the shakeout area? After you see the red bar, the big volume red bar on the bottom there.
This one.
You see that bar.
Yeah.
And then now you're primed because you know that the volume is high. It's a potential shakeout. Where would you take your position now?
I wouldn't take a position on this.
You wouldn't take.
There's too much volume up here.
No, but
that's probably your most likely entry point. Is there where the close is quite close to the close of its previous bar, almost a level bar. That's probably you're looking for a test, and we'll show you that.
So you wouldn't take it, let's say, on the bottom reversal.
No, no, because there's a lot of supply around. There's high volume on the up bar, 2 bars to follow, high volume. And then it comes down, and then it goes up on low volume. So what you're really looking for is a test to follow this. Okay, and I'll show you what that looks like in a few more frames. Anybody else? Okay.
Would the mid-range close also indicate that it's not going to place for a while?
The mid-range close tells me that supply is swamping demand, because if that was a truly strong bar, it would be up close on the high, increase in the volume, and then you'd be starting to see down bars on low volume. Okay, any increase in if the close is off the high, that means that there's supply capping the top. So there is, and
actually,
you can.
That next bar over's got higher volume, and still it goes in the middle
Yeah, so there's a conflict, there's a tug of war going on. Yeah, there's a tug of war going on basically. See, they've made the effort to shake it out, but as it goes up, more supply hits the market. So they've got to take that out before they can get higher prices. Otherwise it becomes expensive. You know, it's a good way to go out of business. You know, support the market artificially. So yeah, you've got your bottom reversal. It goes up on high volume, and then comes down on high volume, and then it starts to go up on low volume. So the market's probably just going to go sideways. There's high volume on down bars, and there's high volume on up bars. And then when you start to get low volume on up bars and low volume on down bars, you're just looking at a sideways track. Ron?
Not to change
Nick?
so too much, but you've recently started talking more and more about successive bars closing at the same level. Is there some general statement you can make about what that indicates, or is it context dependent as to what it means? That seems to be more important than you're thinking lately.
Yeah, what are you talking about up here?
Well, no, the next two.
one.
That one.
Next two.
The level one, yeah.
Yeah.
And basically what that shows is that because the close is quite close to the close of its previous bar, what it means is that the market is actually being supported at that point. It's just that in my experience of studying for long periods of time, I've come to the conclusion that, and if anybody wants to check that out for themselves, they're most welcome to. If you ever see a bar that's very close to the close of its previous bar with a top tail, and the previous bar has a top tail, it usually means there's going to be no further decline. It's going to go up. And I encourage you to look it up for yourself, and just see for yourself. Not to take anything I'd say for granted, but...
So it could mean something different if they were closing close to the close of the previous bar, but they were bottom tails, or...
Yeah. I mean, normally you'd like to see this after a decline. I mean, but because you've got this big sign of strength in the background, yeah, you've got two high volume on up bars closing off the high, shows supplies there. But then look, you've got a down bar closing in the middle with high volume. And then it goes up and comes back down, and then it goes up again. So this, to me, when I see this bar, I like to see this at the bottom of a downtrend, which we don't see here. But because it's close to the close of its previous bar, that tells me that there's no real selling going on here. They try to mark it up. Yes, it has come back down. The volume is high, but it's actually lower than. You see, now, I think this is a slight down bar. It's either slightly down or it's level. This is an older version, so I can't quite tell. If I'd have had black bars, but if that is a slight down bar, then the volume is less than the previous two. That would show potential strength in itself. But don't forget, you've got this in the background, which you can't discount. Okay, so yeah, there probably is weakness back here, but because this sign of strength has appeared, the problem is it goes up then on quite high volume. So then they're now trying to flush everybody out. And they're also trying to punish the shorts as well, probably with this one. Because if you're short up here, you'd be under pressure up here. And as it goes up, you'd probably be under pressure as well. Volume tapers off. So yeah, it's probably not going to break that high, but this isn't going to go away either. So that's probably why this market will just go sideways. Dave?
What about the time it takes for these moves to play out? Sometimes the guys who like me, you think, okay, it's going to move now. And it might take longer than you figured it.
Well, accumulation and distribution phases can take quite a long time. This is a 2-hour chart. So you're not looking at a short term here. You're looking at quite a long term. You're probably looking at 2 or 3 days for this to pan out and maybe even develop into something. So it's not, okay, so we're in and okay, so we're out. It's, that's a 5-minute or a 10-minute chart or a 15-minute chart, but this is the longer term view. So you wouldn't probably necessarily trade on this, but what you might do is say, well, what's the longer term picture? You'd probably use this as, say, like if you're trading stocks on a 15-minute, you might use that as, say, like a daily chart or a longer term picture. You're just sort of trying to get a longer term trending as to where the market will go, not in the short term, but in the longer term. Okay, so principle 2 is stopping volume. Okay. So to stop a down move, demand has to overcome supply, and the odd way the market supply and demand works is evident here. As the market falls day after day, so you must have a downtrend, okay, and then you have widespread down, closing off the lows, and you've got this spike in the volume. Okay, this is the S&P mini 5-minute. So you've got a down bar, fairly widespread. Take out all the all the longs, and obviously develop a situation where professional traders could then can close out their shorts and go long at prices which will not put the market up against their own activity, because the volume is quite high, 68,000 contracts. So when you get stopping volume, you normally get a reversal in the trend, okay? So if the price levels are now attractive for professionals, they will step in and start buying. This activity causes a surge in the volume as they buy and cover their short positions and also go long, you see. So you've got the weakness in the background, the market's come down, you've got no demand there, you've got a nice little no demand there, comes down, that's not a test by the way, you've got a shakeout, widespread down, close off the lows. Now the market goes up on quite high volume and then it starts to go up on low volume, okay, so that's, but you've got the strength in the background, so you'll ignore that, okay. What really brings this to life is this low volume down bar, fairly narrow spread, close slightly off the low, and the volume is less than the previous two, okay. So now you've got this, and now you've got this, so there's two major signs of strength here. So to answer your question, if you get something, even a bottom reversal, you're looking for something like this to follow it. Okay, you've got a down bar, narrow spread, volume's less than the previous two, next bar should always be up, okay, and which it is. So once you start getting one of these, which is going to change the trend of the market, then you're looking for low volume on a down bar, and then the market should go up. This shows no selling pressure, okay? Okay, this is the shakeout and the stopping volume. So widespread down, catch out stops, trigger margin calls, do all the little tricks that these professional traders get up to get you out of the market. What they really want is they want a margin call. They want to trigger a margin call because then you're out of the markets. So it's about 6 hours on average to refund a margin call. Okay, and if they can get you out for 6 hours, then they'll do it. Because that's interference that they don't need. Okay, it means they have to work harder to manipulate. So down bar, low volume, less than the previous two, and what they'll do is they'll sell short to see if more sellers come out of the woodwork. And if the market absorbs that and doesn't make much difference to the price on that, say, block selling, if the market absorbs it, then they know it's strong, and they'll immediately double up on their position and go long. Okay, so that shows there's no selling pressure after many traders were taken out of the market, either on stops or margin calls. So
that is one where you get in because it's got the big sign of weakness, it's got the uptrend, and it's got the no demand.
Yeah, you got the weakness here, you got the shakeout, stopping volume, and it goes up. Volume is a little bit high on this one, but it's not excessive on this one. And then you've got down bar, that's what I call a no supply bar, as opposed to, say, that would be more like a test bar, down bar closed on the high, but that to me is a no supply bar because it's closed on the low. But the volume is less than the previous two, next bar is up, and then a widespread up, increasing volume, and then you're looking for down bars on low volume.
So you don't call it that bar there a test?
Which one? This one?
No.
Or that one?
No. The fourth after the big red,
Call it no supply.
That one? No, I wouldn't.
No supply. You don't
Yeah,
call it,
no selling pressure.
you don't call that a test?
No, it's just me. Tom wouldn't agree with that probably, but it's just the way I personally, because the way I study.
To be called a test, you would have to close in the middle?
You can call that a test. That is really a test, but I like to do. Test to me is close on the high. No supply is close on the low. They're both valid.
It depends on what time frame you're
Yeah.
in. If it was a little longer,
But-
it might recover.
But what really brings it to life is this. You've got to have something like that, or bottom reversal, or some sort of shakeout, or something like that.
But you wouldn't wait for the test to pass or fail before you get in.
That's up to you. You've been in this situation anyway. I know that for our previous conversations. But some people can go in on the next bar. Some people will just take that, say, right, okay, I got that. I'll just put my stop under that low, whatever. And even if you did that, you wouldn't get triggered anyway.
So even if it closed higher in the bar, towards the high, it still has to be a lower bar, closed lower than the previous bar.
Yeah.
Okay.
Right. Okay. So that close means that that's an up bar. Okay. And that close means that it's a down bar. Okay. So that's a down bar because the close is lower than the close of its previous bar, and the next bar is up because the close is greater than the close of its previous bar. And that's what you're looking for. John?
Okay, your no supply bar there, I'm interested in the response to that. It's an up bar, but it's not a really, the real move up is the fallen bar. So the up, are you looking for just any kind of up bar?
Yeah, the close of the following bar should be greater, but don't forget it started out as a down bar and it ended up as an up bar.
And so that's even stronger?
Yeah. Doesn't matter, look, there's no excessive volume there. Look at the volume there, look at the volume there. That volume is only about average. So it's not excess supply there. That's why they're able to push it up, increasing the volume, take out previous top.
If that response bar was a down bar, would you immediately close out your long position?
If this one was a down bar?
Yeah, not wait to be stopped out.
I have done that in the past. I've actually done it on a live trading session. I've had a test. I've gone in, next bar is down, increasing the volume, I get out. I don't, as soon as the volume starts to go higher, if the volume had stayed lower, then I probably would have stayed in if it had been a down bar. But because the volume started to increase, I thought, no, there's too much supply building up, so you get out. You're looking for a next bar, should be an up bar. An up bar means that there's a positive response from this, okay? And if there isn't a positive response from that, then you don't really want to be in there because you don't know what's going to happen next.
What is the significance of the following bar's tail being lower than that test bar?
It starts out as a down bar and ends up as an up bar.
What does that tell me?
Well, it means that they were marking it down to see if there's any sellers, trying to bring out sellers into the market. When they found out there weren't any, they pushed it back up again. They started buying. So it's like, if I'm trying to test the market out and I'm trading against you lot, I might sell you 50,000 of the market. If you're bullish and you're going to take that off me and it doesn't make any difference to the price whatsoever, I know that the supply and demand is swamping supply, because my selling those 50,000 contracts to all of you, you were so eager to buy it plus more, that tells me that there's no weakness. So what are you going to do? You're going to buy 100,000 of the market, if you can. Yeah?
So on that, if you were to, after that test, that no supply bar,
Yeah.
if you were to scale down to a lower time frame, would it matter to you if the volume that undercut that low were lower or higher? Or, in other words, if on a lower time scale, the test below that?
You should have low volume on down bars in a smaller time frame.
No, on the following bar I'm talking about.
That one?
Yeah, in other words, when they're going down below it to test for supply.
You probably would have a test.
But
and then you'd have an up bar.
So it would be low. You would expect lower supply, lower
supply, volume on down
lower
bars.
volume.
Yeah, you're looking for low volume on down bars after you've got a shakeout. Okay, as long as you've got low volume on down bars, it shows there's no selling pressure. So this tells you that there's no sellers coming out of the woodwork,
Right.
or out of the side when prices are declining, and they'll do that. That's the whole purpose of it, to test the waters. It's like if you're going to go for a swim, you put your toe in the water before you jump in. You don't just jump in because the water might be icy. You're going to see what the temperature's like, and that's basically the same thing. They're gauging the supply and demand situation. They don't want to commit money, capital, to a weak market, because to the long side anyway, because that's a good way to go out of business. They have to make sure that what they did here, 68,000 contracts, that's a large commitment of capital. They've got to make a return on that. They can't be going out giving out their capital, they go out of business. So they have to make sure that once they've made the effort of committing that capital to manipulate prices higher, they've got to make sure that they've taken out most of the floating supply. In order to test that, you drive the market down on short selling to see see what the response is to that. And if the response to that is that it's easily absorbed and prices don't go down, that tells you that the market's strong. So you're looking to buy more.
But what I mean is, after that no supply bar, the following bar after that.
Yeah.
Let's say that bar, the one to your left closes. If you move your hand one to the left. Yeah. After the close of that bar.
Yeah.
Now as the next bar is forming, you start seeing either heavy volume on the downside or no volume on the downside. Let's say there's heavy volume. Does that make you think, okay?
If you've got heavy volume on the downside to follow that, then you must assume there's still supply and it hasn't been taken out.
Even though someone's buying all of it, in other words?
Yeah, but that means that if there's that much buying, then there must be a certain amount of selling in there, which means that there's still too much supply. What it would do is it'll probably bring it back down to this level.
I see.
The fact that it's come up here is quite a good sign as well, because normally they'll bring it right back down to around about the close. And the fact that they haven't done it here means that the market is actually quite bullish. If you get low volume on down bars and it's quite high up towards the top of this, that means it's really bullish. And if it comes back down, then they're a bit more skeptical and they just wanted to make sure. So, you know.
Sebastian,
Yeah.
you really say that bar next to that no volume down bar, that because there's a slight increase in the volume, it looks like they threw more stock at to see if anybody else was out there.
Yeah.
And then it came back up, and that would be get ready to go from there.
That's right. It's like almost like a springboard, you know.
Yeah.
You sell to see how much, if there's anybody else that will join that selling, and if there isn't, then you know the market's strong. So you immediately reverse your position and go long.
To see if there's anybody else going to take it.
Yeah. All you're doing is you're just testing supply and demand. If there's more supply, then that will push prices down. If the market's weak, you see the thing is that if the market's strong and other professional traders know it's strong, and a block of supply comes on the market, say like a block of 10,000 or 15,000, they'll take it. That will tell the other professional traders that that was absorbed so quickly that it didn't make any difference to the downside. Now, if professional traders were not bullish, that would result in the next bar being down and the volume increasing probably significant because
Close at the same level as
there's
the
no
bar
buyers.
below it.
Yeah, so that's
Say
selling.
there's some selling here.
That selling would push prices down. And the fact that it's pushed prices up tells you that
There's some demand.
they're just taking everything that's on offer. And that's professional traders do that, not the public. Public don't have that buying power.
You still wouldn't, safely jump in there, wouldn't you? If you had a test of that.
Well, if I saw that and then I saw that, there'd be nothing to stop me.
That's your test.
Yeah, there'd be nothing to stop me whatsoever. Because I can see that an effort has been made
Yeah.
to shake out the market, cover your short positions at a very attractive price. You don't have to put up the market against your own buying or closing out your shorts. You can then reaccumulate all in the same bar, and then you've got to test higher up. This brings this to life. This on its own is basically a sign of strength, but it needs to be backed up. Okay? So this, with this in the background, brings it to life. Okay? You cannot take these bars in isolation because that shows, yeah, there is supply, but that's why you have to test it to make sure that supply is gone. So the effort that was made here has actually worked. Because if, like on the previous chart, you get high volume on up bars, that tells you that the market's still bearish and it's likely to come off. So a sign of strength would probably fail if there were high volume on up bars in the background.
When smart money is doing this type of manipulation, do they have any intentional time frames in mind? Like, this is going to be an effort, this is going to be selling 68,000 over a period of 5 minutes or 2 minutes. Do they synchronize it with time, or are they sort of asynchronous? Is the only way?
I'll probably be able to answer your question in the fall because I'm probably going to be working for a hedge fund.
Oh, excellent.
So I can tell you that. But all these traders, they all respond to other traders, but there's always a leader somewhere, a market maker. I think the market makers, the banks are the market makers, they're the leaders, and everybody else follows them. So, they'll have big clients, say from the Middle East, or, I've seen that, you all know who Brad is, don't you? I was short of the pound against the dollar, and he was short of the euro. The pound dropped, and the euro didn't, because a Middle Eastern buyer came in and started buying. Later on, the price fell, but his buying stopped cap the down move, and he was quite frustrated at that. But because there was no large buyer stepped in and bought cable, I was able to take 41 pips out of the market, whereas he struggled to actually break even. And that's the difference, you see, is that, you have large interests with capital and they have to do something with that capital to try and make a return. So they're acting independently, but they're all observing what everybody else is doing. It's basically like you sit on a fence, everybody's sitting on a fence waiting for somebody else to make a move. That's basically what it's like. And then once somebody sees a large player coming into the market or they'll follow it. I was on life for a little bit on the pit, and all you do is you stand in a pit and you're just watching the brokers, they take the phone calls from, they put the orders in, and being a local, you can see all those orders coming in, so you can jump the gun. You can get in the market before they, because if you're a phone booth broker and you're trying to get the attention of your pit trader to execute that order, you may not get his attention for like 30 seconds. That gives you all the opportunity you need to see what's going on, see the amount, at what price. You can jump in.
You guys are forefronting all those orders.
Yeah, you are. You're just jumping in ahead of those orders if you're quick enough. But most people, there's a, like in, I remember there was a guy who was in the paper. He made a lot of money, millions and millions of pounds, and just trying to think what market he was in. I think it was the Bund or something like that. But he was the biggest player in the market, and he basically would just control the market because he had that buying power to do that, long or short. But he could just move the market around, and a lot of the traders just followed him. A lot of the locals just followed this guy. I mean, he was in the paper he had absolute fortune, and the paper were looking for people who knew him because he was a big golfer or something like that. But you know, in the pit, you just follow the biggest trader in the pit because you know that he's got the money to move the market and he's got the capital. So when he's active, you're trying to second guess what he's trying to do, and you're trying to keep up with him.
And he knew he was being watched.
Oh yeah.
So he would play with people.
Well, you
So,
probably
yeah.
don't mind since people are following it.
Yeah.
You don't mind.
But that's why you have stop loss catching maneuvers, because these guys know that there's going to be a certain percentage out there that can follow their tracks. I mean, if you read any books on Wyckoff, I mean, he was running the Ticker magazine. He ran a subscription magazine, and it was so successful that all the brokers and all the brokerage houses across America were giving it to their clients. I mean, you'd have thousands, tens of thousands of market orders, and the professional traders just realised that it was just cancelling out all their work. All their work to accumulate stock was then being undermined by the public jumping in, doing exactly the same thing as they were. So Wyckoff had to, find another way of getting that information to his clients. But it becomes self-defeating if everybody knows what everybody else is doing. I mean, there has to be losers. The market works on losers, and the public have to be losers because otherwise the professionals wouldn't be able to make money out of it. That's why there's so much misinformation out there. You watch CNBC or Bloomberg, you can't trade off that. I once saw a couple of weeks ago, last time I was in Chicago, Bloomberg had an analyst recommendation for Goldman Sachs, and I think I mentioned that on a live seminar. It went up, and then it just went down again. And that was from the broker or the analyst goes on Bloomberg, they give a recommendation to buy the stock. That gives the insiders ample opportunity and even a market to sell into, because those uninformed traders are coming into the market like, housewife who's got a baby. I've seen it. I've seen programs on it on the news. You got this woman. She's got a child. She's saying to the child, "What stock will I buy today?" They'll be watching Bloomberg or CNBC. Analyst comes on with a recommendation. They'll call up their broker and buy it. That specialist and those inside traders know that there's a ready market once there's been an analyst recommendation to sell into, and that's why the prices will always decline. You could buy and sell stock just on that alone and make money.
So, can I ask one last question?
Sure, John.
You see the stopping volume bar.
Yeah.
Imagine all of the right bars are shifted down.
These.
Yeah. So
Yeah.
imagine
So round
a
under.
scenario where all of these shift down, so this is actually a down bar here. Does that change your scenario?
Yeah, it does. But then you wouldn't be looking at it. If that happened, this
But
chart
that's
wouldn't be
not
there.
real stopping volume. It's likely going to keep
Well,
going
what would
south,
happen
right?
then, John, is that this would be the start. Okay. Now, if all these bars were flip side, I mean, I think we saw that on.
Flip necessarily, just shifted lower, so that you didn't have a follow through from that stopping volume bar.
Right. Well, the thing is that you want to be looking for a test and a rising market, which you wouldn't have because all these would be down. The market then that would just be market would just go sideways, and you'd have up bars and low bars on low volume, up bars and low down bars and low volume. That's what you'd have. So all that would do is it would just mark the market sideways until another force came in to change the trend. But yeah, I mean, this was probably done on bad news, possibly, and it was probably just a golden opportunity.
So I guess my point is, for it to really be stopping volume, you want to see the next bar as a close higher.
Yeah, next bar should always be up. If you've got a down bar and you've got high volume, the next bar should always go up. That will show that a lot of supply was taken out of the market at that point. So the result was that because demand swamped supply at that point, that drove prices higher. But you're looking for a test, John. You're not looking to jump in on one of these bars, because if there's no response from this, the market will just tick off, and you don't want that. Okay, they've committed the capital, and if they want to take that risk of losing it, that's up to them. But you don't want to do that because you don't have 30-to-1 margin. It'd be nice if we did, because then we could live through upthrusts and all that sort of thing. But You know, we can't do that, especially on the DAX, right?
Yeah.
So that, yes, is stopping volume, but you've got to look for that to follow. Because if you don't see that, you know, or something very similar, low volume on down bars, then you can discount this. There's no result. That's an effort to accumulate, and if there's no response to that buying, then the market will probably come off. Any more questions before I... Tom?
On the second bar up, it looks like a no demand bar.
This one? Or
One
that
more,
one?
yeah.
Right.
And if you're too quick to go in, you're going to be on the wrong side.
Well, the thing is that, yes, it's an up bar on low volume, but that's why it's tested.
Yeah, but I mean, if you're looking for a no demand after a...
No, you're not. You're not looking for no demand because you've got this.
Okay.
Okay, this represents the flip side of weakness. Okay, so that's why you've got to take the background into... Once you start to see this, then your attention should start, you should start to focus. You know, I mean, that's a pretty much sideways market until the shakeout. But if the market wasn't bullish, they wouldn't do that. That's to bring in as many shorts as possible and to also lock people in or out of the market. And the test is just to make sure that that was actually what they intended it to be. So you ignore signs of weakness when you've got strength in the background. Gavin actually did that on a live trading. He was looking for no demand with a shakeout in the background. I can't believe it. And I'm saying to Gavin, you know, why do you want to go short? And he lost money. Yeah.
That widespread down bar on increased volume.
That one.
Oh, yes.
That's excessive volume. That's not an increase in volume.
All right. If you were looking at the left, and let's suppose there was a long consolidation, and that was a breakdown from a long period.
You're talking about like that?
Yeah, but let's suppose it really was even longer than that. There
Right.
was a base almost, or
Right.
a consolidation, and then you see a widespread down, breaking down on very big volume.
Yeah.
There are times when that will be the first beginning of a long downtrend. You know, in other words, that you get this big volume breakdown, it backs up on low volume right below the base, and then it comes off again.
Yeah.
And there are other times when it'll be a shakeout.
That's
It'll
right.
be a shake. So how do you what are you looking for to help you distinguish between those two scenarios, where we have a breakout?
I've got a chart of that I can show you later.
Okay.
Yeah, I definitely got one. I know what you're talking about. You're talking about a push through a previous support area.
Yeah. And then it backs up on.
But then you're looking for weak bars to follow, not strong bars.
You're looking for weak bars,
Yeah.
and then it just goes down further, and
Yeah.
then there are other times that it's a shakeout, and it'll just go
That's
up.
right. But the trick is that you guys will be in that 1% of people that will be able to differentiate as to what the market is likely to do next. Whereas that 99% are just guessing. You know, they're just guessing, and you've got a real advantage over people once you start to understand this in relation to this. You'll have an advantage that most people can only dream of.
But Sebastian, to answer his question, we were talking about that consolidation area, and then it does, you know, just ramps down. Where we would actually, what we were talking about in the last seminar, take those strong bars and weak bars, and really look at count the number of strong bars and weak bars in that area of consolidation, and then that gives you a heads up as to what it's going to do.
Yeah, I'll give you a total, and then you'll know whether the market's stronger or weaker. It'd be nice to have the computer program to actually do that for you.
Yeah.
But if you're going to do that, then that would be a starting point, because that would be professional activity. And then you say, right, okay, strong bar, next bar up. That's strong, potentially weak because it's gone up on low volume. Strong bar, strong bar, strong bar. Potentially weak. Down bar, low volume, less than the previous two. Potentially strong, strong, strong. So you'd say, right, the market's stronger because you've only got you've only got about 2 or possibly 3 weak bars, and most of them are strong. So that's how you do it.
That's an interesting question, and I know you don't trade support and resistance, but that's actually a lot of us do.
Right.
And that's going to be a very interesting. We can talk about like yesterday when S&P broke 880. Well, didn't last very long, but still.
If you're a support and resistance trader, I might just have a plan that could
Cool. Looking forward.
that might be good for you. Janet's already seen it. And
Cool.
She quite likes it.
Cool. Looking forward.
It does work. I've proved it. So.
Great.
Okay. So how are we doing for time? Yeah, we're still okay. Good. Right. Okay. Principle 3. Okay. So this is a test, and obviously we've got a down bar closing in the middle. Volume's less than the previous 2. But what brings that test to life? This is an interactive session, so I'm going to be asking you some questions. So, what brings that to life? What if you saw that? What would you
the bar, the high volume down bar, of
That
course,
one.
red one, yeah.
Yeah, so what brings that to life is that. Okay, so quite high volume on this up bar. You've then got a low volume up bar closing in the middle, potentially a weak response from an effort to shake the market out. But then it's tested, the next bar is up. This is what Tom would probably call a test as well. So you've got bottom tail, and it closes as an up bar. Volume should always be less than the previous two, and it's not on this one. The market does manage to go up from there, but it just drifts up. Okay, but yeah, you've got a bit of stopping volume there. Market then goes up on high volume, got a close in the middle bar, and it starts to come down, increasing the volume. Okay, closing slightly off the low, and then you've got a test. Down bar, close in the middle, that's a very strong bar, next bar is up. Okay, that validates that test because the next bar is up. That's why you've got the signals appearing, okay? But the volume is less than the previous two, and it's come back down into a previous high volume down bar. Okay, so because you had that little bit of weakness, it wasn't anything too significant, that's why they brought it back down into this previous area. And that happens on the DAX all the time, by the way, Rick. You've got high volume down bar, close off the low, high volume, then come back down, it's made a retracement back down into this previous low where there was high volume, and now there's low volume. That will tell you, that would be a warning for you that the market is bullish, it's not bearish, and they brought it down to bring out any shorts. They want to encourage as many uninformed traders to go short as possible. If you're using moving averages or MACD or something like that, that'll probably give you a sell signal. So you'd be selling into that, whereas because you couldn't read the volume, that would be telling you the opposite. The market's actually bullish. What brings it to life, as you quite rightly said, is that. Okay, so that's the cause, and that's the result. Okay, so they've made an effort to push prices down and buy against that supply, and then they've tested it there to make sure that it is actually strong. And if there's no response from that, then they just withdraw. Okay, so that's what you do. If you see no response, if you don't see an up bar from that, then that tells you that it's not going to happen. So you want to just get out.
So the only thing that would make that better would be if that were an inside bar.
Yeah, but see, the thing is, yeah, down, but that would be very difficult to be an inside bar,
Yeah.
unless that was a widespread down, close on the high, and then if you had the next bar as an inside one, but that would have to be really narrow for that to be an inside bar. So, but what I really like about this is the close is just about on the low, but it's lower than the close of its previous bar. So actually, I do actually like the fact that it's within that. The close is within that close and that low. Okay, and that's also one of the criteria that Alan, I showed you that chart. When I see those arrows appear, that closes within that lower part. Okay, so the response from that is that the price goes up. So, so that's principle 2 is 3. Sorry, is a test, but it has to be brought to life. Okay, has to be brought to life. So be very careful if you see high volume on up bars, then this will probably fail. But you don't have really high volume. I'll show you an example of that later. I've actually got examples of why tests fail. Okay, and how things can fail and why. Because it's actually just as important to know how and why something's going to fail than it's going to succeed. There is actually a flip side to it.
So when not to go?
Yeah, you know. But then the problem with volume spread analysis, as I've got more and more experience, is that it's then down to interpretation, and you can actually have an information overload, which can actually cancel out everything. I mean, I don't know if any of you have got to that stage yet, but there's actually a point where I couldn't actually make a trade because I saw strength and I saw weakness both at the same time. So what do you do? You just can't do anything. So you have to sit out of the market. And it becomes very frustrating after a while.
Would you take a position here?
Would I take a position? I probably might take a position on that, and I'll just have my stop just under there, under that low. See, that test is quite close to the low of that, so I'd say, right, I'm willing to risk that.
It's probably low risk because you wouldn't lose that much.
Yeah. So, I mean, you'd be thinking about it at the bottom part of this tail, but as it closes up, then you'd know that that was actually genuine. The fact that, well, I mean, there's 2 scenarios there, John. You've got this high volume on down bar closing off the low. That shows you that there's more demand in there than supply. It comes up, it goes up, a little bit of weakness, but then as it's tested, see how the close is quite close to the close of its previous bar. You could actually just go long on that one. So I'm sure there's a lot of people out there who do go long on the next bar. But if you're really aggressive, then you could take the test. But then it could always fail. But then that's when it comes on to the advanced stuff, which we'll get onto later. So, you know, next bar should always be up, and, you know, you could take your position on the next bar. Because that's confirmation, isn't it? Because if that fails, then the effort versus the results would be that they've made the effort to accumulate and to retest, but the result was that if it failed, market's obviously weaker. But there is actually a way to distinguish whether it's going to happen or not. So, any other questions on that before I move on? Okay, so principle 4 is down bars closing in the middle, okay, on reduced volume, seen after any sign of weakness indicates higher prices. So what we have here is we have what probably is some sort of accumulation phase. Okay, now we've got a breakout, but there's quite high volume on these up bars, okay, and that's why it's tested. In fact, TradeGuide has actually given us a weakness indicator. Okay, so that's a bullish bar, but then that's a weak bar potentially because it's closed in the middle and the volume's still quite high. Then it goes up on low volume less than the previous two. Okay, so that's not indicating weakness as such because you've got this in the background. But that's why it's tested, you see. So you've got any high volume on up bars that comes into the market should be tested if the market's still strong. Plus you've got higher lows. Okay, so the market is actually in an uptrend. So you wouldn't want to short that anyway. You wouldn't really be interested in shorting that because you've got higher lows. Okay, so because the market's tested after an increase in volume on up bars has appeared, that tells you the market's still strong. So you don't really want to be going short on that. Plus you've got potentially an accumulation phase in the background, which you want to be careful of. Okay, so any questions on that? Looks like a pretty straightforward one. Right? Okay. Good. So test and rising market, got an accumulation phase, and initially you've got a little bit of high volume, close in the middle, but because you've got this accumulation phase, that's really not going to happen, and that's why you get the test. And once you see the test, then you're practically guaranteed higher prices. Okay, and that is cable 15-minute chart. So that's actually quite a nice example. I would say that a lot of that was actually buying, breakout buying, because as soon as this price level's broken out of this, everybody's jumping on the bandwagon, I would say. That's what I would put that down to. But if you see this, after you've seen a high volume, or an increase in volume on up bars, closing off the highs, that tells you the market's still strong. Another good example, another good indicator is that you've got higher lows. Okay, so once you've got higher lows, you don't really want to be looking for shorts. When you've got lower highs, then you do want to be looking for shorts. Okay. Principle 5. Okay, a widespread up bar closing on the highs, pushing up and through an old top to the left. So here we have an old top to the left, and we've got this accumulation phase, you've got buying back down here, and then pushes up through. Okay, the market has a short rally. This is demand in an effort to go up. After the event, the market usually rests or starts to react, which is actually what you can see there. It starts to rest. Okay, you're now looking for signs of confirmation of strength to confirm the strength. Okay, so market comes down. You've got quite high buying here, quite a lot of buying. Markets go sideways. You've got low volume on that down bar. Okay, then you've got another low volume on that down bar. So you can actually see from here, although there was quite high volume on that up bar, there was actually buying there, so the next bar is up. So you would say, right, okay, now I'm going to take my count. So widespread down, close on the low, high volume. So the high volume bar is your starting point. Up bar, so that's potential strength because you've got widespread down and next bar is up. That shows there was more buying than selling on this bar. Okay, now it's potential weakness on that one. And you've got strength because it's down bar, low volume, close in the middle. Close is quite close to the close of its previous bar. Then you've got an up bar. So that's 1, 2, 3, 4 against 1. So we're already looking at more strong bars than weak bars. And you've got another down bar, close in the middle. Volume's less than the previous two, that's a good sign. Okay, so that's another strong bar, so that's 5 against 1. That's potentially an up bar, although the volume does start to increase. Okay, so this is a strong bar, that's the result, so that's quite healthy.
Okay, so that's the result of the test,
Yeah.
basically, before.
Yeah. Yeah, you're getting high.
I first thought that was a weak bar, but I see it is response to the test.
Yeah, you've got a low volume down bar, close in the middle, less than the previous two, and the next bar should always be up. Doesn't matter if there's an increase in volume, because bullish bars, you've got always increasing volume on up bars and decreasing volume on down bars, but it should never be excessive volume on up bars. And as you can see, this is about average. Okay, that's an hourly chart. So you got it's fairly healthy, and you've got a down bar, low volume. You then got another starts off as down bar, ends up as an up bar. So these are basically Wyckoff tests. So these are all strong bars. The market's not falling. Look, it's holding. It's going sideways. It's holding. From this point, it's under accumulation. Okay, so you're looking for down bars, low volume, down bars, low volume, down bars, low volume, down bars, low volume. Slight bit of that bar I would personally ignore, because it's probably saying it's no demand, but it's not, because you've got strength, not weakness in the background. So then that's why it pushes up and through. So if you do your count from your high volume bar, it doesn't matter whether it's up or down. That's where you start from. You can tell immediately that this is strong. This market's going to go up. There's just no weak bars in there. Okay, so a widespread up bar, closing on the highs, pushing up and through, and on top to the left. It should be tested almost straight away. Okay, and as you can see, the market pushes up through, and you've got a test straight away. Down bar, close in the middle, volume's less than the previous two, and then it starts to go up. Another down bar, low, volume's not less than the previous two, but it's a down bar on a narrow spread, and next bar is a wide spread up. Okay, so it's actually trying to take out these highs back here. So that's temporary sign of weakness. Got a low volume up bar, but it is tested on the previous bar, but there is a little bit of supply there. But it's still in an uptrend, it's still going up, so the market's not actually bearish at that point. But I'd be very surprised if the market was bearish after this anyway. So we've got an old top in the background, but you're looking for continuations of signs of strength. Any questions on that? Okay. So are you following this? You're following this? Okay, good. Well, the thing is that, I mean, 2 or 3 weeks ago when I came here, I thought that if I was going through all this stuff, then I'll just be boring all of you to death. But then, people started saying, well, it's like if you're learning to play tennis or you're learning to play football or whatever, it's practice and it's repetition. So maybe it's not so bad after all. So, right, okay. So, principle 6. It's one of my favourites. This is a very powerful indication of strength. First you see stopping volume, which is there. Okay. Shakeout, this is on a stock, AXP. So you've got stopping volume, demand is swamping supply, which is why it's closed in the middle. Then very interestingly enough, you've got a down bar and the volume is low. Okay. So then we have a test-like bar at the bottom here, and it ends up as an up bar. Okay. So this could be construed as one of the 9 Wyckoff tests. The volume has to be less than the previous 2. Okay, I'll show you better examples of this later because I know I have some better ones. But any down bar closing on the high into a previous area where there was supply, which is what you have here, is a sign of strength. And as you can see, the response from that, from the other market participants, is that they drive prices higher. In other words, this is your shakeout, close in the middle. It's a good sign. They're giving you a sign of weakness, but I would just ignore that. You've got a down bar, the volume's not excessively high, it's a bit above the average, but then it starts off as a down bar, closes as an up bar, but the volume's low. So that's because you've got this, Tom says that because you've got this down bit here, demand was swamping supply, so therefore it ended up as an up bar. Although it started out as a down bar, it ended up as an up bar. Okay, so that's quite bullish. Okay, volume's low, shows there's no selling pressure there. got the shakeout in the background, close in the middle, then the prices just go up. Okay, so, but I'll show you a much better example of that as we go along. And I think that's probably why I gave you a second example. So, down bar, close in the middle, okay, and then you've got another down bar with a very narrow spread, close in the middle. It's not an up bar, it's a down bar, it's still okay. Okay, the volume's quite high, but because the spread or range is narrow, close in the middle, then you know that there's the specialist and his friends are still buying on that. So it comes back up, and then you get a retest. See how you got low volume on down bar, narrow spread, and it's above, so it's actually quite high up. So that tells me that they're unlikely to bring it back down into this low back here. So then you have a down bar closing in the middle. The volume is low, it's less than the average. Compared to this bar, if you look at the volume on this bar, and you look at the volume on this bar, the volume on this down bar with a fairly narrow spread closing in the middle is actually much lower than this. Okay? So what they're doing is they're retesting it. The effort is to shake the market out, catch all the stops and the margin calls, and then they bring it up, and then they push it back down into this previous area where there was supply, just to make sure that all the supply has gone out of the market. So that's, if you ever see that, then that's, you want to be looking for, to get in on a test or something.
So if you were to give a quick label to this, it would be stopping volume followed by a test.
I'd say that was a shakeout followed by a retest into that area. So it's the effort, and the result is that the market is strong as opposed to weak to follow.
Yeah, but that last bar there, it's a down bar and it's got some volume on it.
Yeah.
So
This one you mean?
Yes, so it's almost like you get a little bit of supply in there.
Well, no, not really, because how high is that volume?
Slow.
That's your average volume line, right? Okay.
Right.
And it's on a up bar or a down bar?
Down bar.
Right. And is it close off the high or close off the low?
Goes up the low.
Right. So what does that tell you? If you've got down bar closing off the low, what does that tell you? There's enough demand in there to bring it off the lows, right? Now, if you take that bar there and compare it to that bar, what is it?
Okay, but then you compare it to the 2 bar previous, it's got more volume. It's a down bar than the 2 previous bar, and it's got volume on it, so it's almost like it's going down.
Yeah, but this is what you're comparing it to.
Okay.
Because that's where the effort was, you see. They made a conscious effort to shake as many trigger as many margin calls and stop losses as possible. And what they're doing is, as the market's falling, you're looking for, it doesn't matter, it's not necessarily that one. I mean, these ones will be perfectly valid. They're down bars. You're looking for down bars on low volume into this previous area. It just so happened that that one was about the lowest of all of them, which is why I highlighted that one. But if you take the volume of this bar on this down bar and you compare it to that, which is what you're supposed to be doing, you will see that there was supply in the market here, and now there is no supply in the market. And that's why they do that. They do that to make sure that all this selling that took place here, although there was a lot of buying, all those sellers are out of the market. They don't want to have to support the market to any degree which will reduce their profits, because the reason why we have shakeouts is to kick the balance of supply and demand in your favour. Okay, that's why they do it. So in order to make sure that what these down bars are to do is to encourage short sellers, or people who have long stocks, who are long of stock, who might be under pressure to close it out. That's to encourage them to get out. Down bars will, put you under pressure emotionally to close out, either at a loss or at a break even, or maybe even a small profit. They want your stock. It's not in their interest to just quickly mark it up, okay? Unless they want to lock in those long holders, and they don't want to encourage all that selling at high prices. The reason why they do that is because they don't want to have to keep buying and buying and buying as it goes up. They want the path of least resistance to be up in its own right, and that's why you have that. This in itself is a sign of strength, but this confirms that is a sign of strength. Okay, so you can see that from these low volume on down bars, and even that one, there's more buying on that one, That's why they keep marking it back down, to try and flush you out, to get you out of your holdings of stock. Because if they don't do that, then it's going to be more expensive for them higher up.
Yeah, but on that bar down there, before the the third bar from the right, there's a lot of volume on that one. It's a down bar, so
Yeah, but
there's still some supply.
But what's the next bar?
That's enough volume.
So what would be the response from that, would you estimate? So if
Down
there wasn't,
bar, a lot of supply.
if there wasn't,
it'd be weak, it'd be gone down.
yeah, but even that bar there compared to that bar is still
Yeah,
low.
yeah, but to me, I'm just trying to understand that part of it. It says, yes, there is some selling in there, but if it be a real weak bar, the next one after that would be down again.
Yeah, exactly. Yeah, you're getting it good. So yeah, if that was weak, then that would be, the response would be down, not up. But the fact of the matter is that because it's up, you got that buying in there, so that may well not have, come up to anything. But what they're doing is, I think that they're just trying to encourage people who maybe went long here to close out their positions. And that's why they keep doing it. They keep marking it down to tire you out, flush you out. John?
Yes, so really, to summarize what we're saying is, we all know what a regular test is. We're looking for low volume. But these are kind of different kinds of tests, where you have down bar, close in the middle, higher volume, perhaps around average, and then the response is the next bar, it goes up. That's kind of an indication of buying there, that it's, the professionals must see the market is so strong that they take it down a little bit, they're buying more,
Yeah.
and the response to that is the supply-demand fundamentals, the next bar has to go up.
Yeah, but that's their marker.
Right.
Right? That's what they're comparing it to. They're comparing it to that. That was the big effort. Okay, so as they push, as prices go up naturally from this, they'll force it back down here just to make sure. They'll force it back down to flush out any possible weak holders, but also to encourage anybody to go short. A lot of people will go short on that, and then they get caught right out because they can't understand this. Their MACD or whatever, the RSI will be pointing downwards maybe at that point. There's a small downtrend, and that's what they all know that. That's why when I say this is unique, when you can still read this, it gives you a unique perspective that nobody else has.
And so where would you go long here?
Where would I go long? I might possibly go long on, say, that one, or maybe that one, possibly that one. That one's a good, I would wait for a test to follow that, because obviously down bar, narrow spread, close in the middle, there is supply there, but I'd wait for that to be tested. Next bar up is a very bullish sign. So I just, any low volume on down bars into this.
And your stop would be just below the low of that over there.
Yeah. You're unlikely to get stopped out there unless the picture really changes. Yeah.
On the third bar from the right,
Yeah.
the high volume bar,
That one.
I just want to know if maybe I'm interpreting it incorrectly or correctly. I look at that and say there's a lot of effort to go down. There's a lot of activity. But at that point, it seems that the scales are tipping because there's a lot of effort, but there's no real result. It's not. It's a pretty narrow bar. It's closing similar to the test a few bars before.
Yeah.
And it's big volume, and it didn't go anywhere. So the scales are tipping toward the demand side. So at that point, do you want to see a test of that bar? Or
Yeah, that's why I said you will be
you
looking
want
for a
to see
test
a
of it.
test. You don't
Yeah.
just say, okay, it's time to go in because the demand.
Well, I can't tell you how to trade, but I would say personally, from my own point of view, then I would be looking for a test to follow that because there's more volume there.
Okay.
That's yeah. If you see any down bar on high volume closing off the lows, you want to see a retest of it.
Why
at
is
some
that
point.
next bar positive then? When you say that's a...
Well, the response from this down bar closing in the middle is an up bar. So therefore, we have to say that there must have been more buying than selling on this bar to push the next bar up. The balance of the laws of supply and demand show that the demand is there enough to push prices higher. Do you see what I mean? Now you can see why. This starts to show you why demand or strength, when it appears, will always appear on a down bar, not on an up bar. See, most people's perception is that weakness will always appear on a down bar, strength will always appear on an up bar, but it's not true. And by showing you the volume, showing you how to interpret the volume, you can actually begin to unravel. Yeah, you can actually see it much more clearer than you would otherwise. But yeah, down bars, increasing the volume, close off the low. The next bar up is strength, but you want to see it tested. Now, yeah, because high volume on down bars shows that there is actually supply present. You've got to make sure that's taken out. There probably would have been a lot of bad news on this. In fact, if I did a search for the date of 1st of December 2006, there probably would have been a lot of stock. Probably would have been bad news over the previous 2 days.
That's right between Christmas and New Year's.
Yeah, but it's the 1st of December, so DD, I think that's DuPont, isn't it? So yeah, so there would have been some bad news on that. I'm sure if you came up with the news for that day, probably, or those 2 days even, it probably would have been quite bad. But high volume down bars, close in the middle, show strength. Then you've got a down bar on low volume. That shows the effort to absorb the floating supply out the market must have worked. So you've got a low volume down bar, and then the market then just goes up. You've got another strong bar there. You see how the close is quite close to the close of its previous bar? If you ever see that, and the previous bar is a down bar, that shows, especially if the volume is low, then it's not going to go any lower. And as a result from that, it's a wide spread up, as you can see. So that's why you should never, you've got down bar followed by another down bar with a close, lower than the close but greater than the high. Do not ever short that, because you're likely to be burnt. Okay, so probably done on bad news. So the principle is that you've got 2 down bars, high volume, second one is close in the middle, right? And then you've got a low volume down bar to follow, low volume down bar to follow, low volume down bar to follow. Okay, so you see, you observe the principle, but you don't take any actions on that. You have to wait for the result. And if the result is that you don't have lower prices on high volume, you're looking for lower prices on low volume to test, as it were, then you know the market's still bullish. And as you can see, that it doesn't actually make new lows. Okay, actually it just goes sideways and it starts to make higher lows. Okay, so it's not actually making new lows from these lows. Okay, so there was enough of an effort in there to initially mark the market sideways, but as they pushed the market down, there was no real selling pressure to that. That told the people in control that it was actually bullish. But you won't see this one that often. Some of these are very difficult to come across. Some of these I've never ever seen. Some of these principles, never seen. So sometimes you have to make up charts in order to show you the example of something you may never see in your lifetime, which is crazy. But they must have appeared at some point, because Tom wouldn't have taken the trouble to write them down.
But this one with the second bar down,
Yeah.
the 2 big bar down, the 2 big red bars, the first 2 ones, it almost looks like when it's really going to break support, it's really going down. The next, you know what I'm saying? There's a lot of volume when they're going down.
Yeah. You see,
I
that's
guess the close would be more lower than that. The
Well-
close goes by would be lower than the bar.
well, if that was a genuinely weak bar, it would have to be lower than that, because that you could probably say was a support area. Would you say that? Because I'm not really a support and resistance trader, but
No, but not only that, I think that probably the close of those. I'm just saying that when it goes down to support, that's about what it looks like. Those 2 bars, not the one after that.
yeah. So as a support and resistance trader, you'd say that that was support off that line. If you drew your line across there, then you'd say.
It's going through.
Well, you see, the thing is that there's another trick up their sleeve. Is that you've got this low. Supposing you draw your line across that low, right? It then breaks that. A lot of people will be going short on that bar, right? And these traders, they know that. They know that they can mislead people. So how many short sellers are there on there from below the breakdown of this low? Quite a lot, I would imagine. So that gives them a golden opportunity to buy, doesn't it? I mean, you've got all these short sellers coming in who are uninformed because they're trading support and resistance. And you've got a golden opportunity, haven't you? I mean, you're not putting prices up against yourself. And there's a whole bunch of short sellers who are now going to get whipped, in a few weeks or whatever. I mean, you can see why the tricks that they play are so lucrative, because that's why they do it. That's why you have good and bad news. That's why you have all these, CNBC and Bloomberg. They are aiding and abetting the specialists and all these professional traders, because they are bombarding you with information, putting you under emotional pressure. So if you're support, this is why I don't trade support and resistance. If I shorted that below that line, I'm going to get killed. So, but this is when you can read the volume. You can say, hang on a minute, that is not genuine weakness. That is strength. So therefore, I don't want to short it as it breaks this previous low.
But that's turning that bar is the fact that it didn't close at the lows, it really closed in the middle.
Yeah, this one is
Also
closing
high.
in the middle, yeah.
So that's the main element that tells you to strengthen that bar.
Yeah. Got high volume down bars. The fact that it's closed in the middle shows you that demand is swamping supply. Okay, now if it was really weak, it would be closed down here, and then it would be closed down there, and then it would be closed down there. But any bar that closes off the low on high volume, you've got to say, oh, hang on a minute, is this real weakness, or is the fact that it's closed in the middle show that the demand is swamping supply? Then what you're looking for is you're looking for low volume on down bars with a fairly narrow spread. Next bar up, down bar, low volume, less than the previous two, next bar up. And then again you've got more buying here. That's why you've got that wide spread up.
I need to check that on what happened yesterday.
Yeah, and this is the effort, and the result is testing. I mean, it's a big tip. It's a big tip-off. You know, I mean, that's the beauty of this volume is that, you know, they can lie to you any which way they want to, but as soon as you start to read this, they can't lie to you. You know, you can see through it. You can cut through it, and that's the beauty of, you know, being able to read the volume is that you can you can separate the lies from the truth. If you've got bad news and you look at your chart, you've got high volume on down bars, you say, oh, that's brilliant. You know, I mean, look at 9/11. 9/11 was very similar to this. Really bad news, as bad as it can get, apart from maybe the president getting shot. And what was the result? The market went up. You actually had a bull market after that. You know, a few weeks after. I mean, the last couple of weeks ago, I mean, you saw it, Janet, Alan. It was testing on the Dow after that. I've got the picture. I might even show it to you later. So any bad news, and you've got high volume on down bars closed in the middle, you've got to say what's really going on. So then you're looking for low volume on down bars to confirm that this is actually strength and not weakness. Okay? So you've got to be real careful of that. Okay, number 8. Okay, this is a hidden test. Okay, and this is probably one that most people find quite difficult. I found it very difficult for quite a long time. Here you've got a down bar, close in the middle, high volume, so that's your starting point, okay? So you've got the test, and then it goes up, closes on the low, but the volume is low, and the next bar is down, still low volume, okay, so this is still holding, and you've got an up bar, close in the middle, still there's low volume, a little bit of supply there, but as it comes down, you've got a fairly wide spread down, increase in the volume, and then it starts out as a down bar, closes as an up bar. Okay, so that is a hidden test. Okay, so it started off as a down bar, ended up as an up bar. Okay, but personally, I don't actually use these. Okay, I don't actually trade off these because I actually don't like these bars at all. That to me is a lot clearer than this. Okay, but what really has brought this to life, I mean, you could almost say that was a Wyckoff spring off this low. Okay, so previous bar has to be down, preferably on an average to wide spread. Next bar has a lower low than the previous bar, and starts out as a down bar, ends up as an up bar. Okay, and as you can see, it is tested. The volume is a little bit high. If it is tested, the next bar is up. Okay, so that's what you're looking for. Okay, so you've got a down bar followed by a lower low, ends up as an up bar. The close should not be higher than the high of its previous bar, and the volume should be low. Okay, and it should be an increase in the volume on the down bar, and if it closes off the low with an increase in above average volume, that's good. And you've got another test to follow it, although the volume is a little bit high. The market does respond to the upside, and that's Barclays Bank daily. What really brings this to life, you cannot look at that on its own. You've got to look in the background. And what did I say about looking in the background? You've got that. Okay, so that's a hidden test into some sort of shakeout. We've dropped the market down on that day, probably on bad news again. High volume, a lot of weak holders being flushed out. Golden opportunity, and then it's tested, and then it goes up.
So that volume was a test of the effort on
Yeah, the effort, that was the effort to shake the market out. They gapped it down on the next day, probably on bad news of some sort, and then it rises a little bit, they sell into the up move, they bring it back down, and then you've got a hidden test, and then the market goes up. I can probably show you a better example of that. So,
And Sebastian, one question on this is we read these charts. Really, what we should be looking for is down to confirm the big volume bar there. We're looking for down bars with low volume. And
Which you have there, you've got fairly widespread down. The volume compared to this one is low. You know, the volume on this bar compared to this bar is low, and it comes back down into this high
but
volume.
even the bar immediately after that, this down bar,
Yeah.
low volume.
Yeah.
Bar after that is very low. You know, it got knocked down, but you'd think that'd scare out, if anyone was selling it, it'd scare them out and it'd create big volume, but it doesn't.
No. What they're doing is they don't want the market to go up straight away, because they know that if you buy here and you shake the market out, there's basically going to be no buyers. There's going to be no selling pressure up here. But you don't want to mark the market up straight away, because you want to make sure the market is actually strong before you manipulate prices higher. I mean, you really just don't want to do that. So that's why they keep it down. They cap the prices until they can retest it, make sure that all the effort that they made here is going to pay off, and it's not going to cost them money that they don't really want to sort of give away, as it were. Because if you commit capital to this, you want a return on your money. You want a return on your money or your customers' money. You don't want to see that go down the drain. So that's why you have to keep prices within a narrow range and then test it. And then if then you can see the market's still strong, then that's it. You know you're going to get a decent return. Otherwise, you just close out, or then you hedge your position with puts, something like that. Okay, so are we all happy with that? Everybody? Okay, so okay, this is number 9. Okay, this is a selling climax. Okay, this is on the Dow Jones Industrial Average, 16th of August 2007. Okay, so selling climax. Tom says widespread down, closing in the middle or high. Okay, which it does there, closes on the high, after a substantial down move has taken place. Okay, the volume is ultra high, which it is here. Okay, it doesn't, right, so what's the volume says high, but it really should be ultra high. As the market falls day after day, a point will be reached when traders will start to panic, encouraged by bad news, will start to dump stock onto the market. If the market closes in the middle or high, then professional money must have decided that lower prices now looked attractive and will start to buy into the panic selling. This activity will cause the volume to be ultra high, such as it is here. Okay, and this marks the low point of the market. Okay, so what you're then looking for is a retest, which you've got a test there, and then they bring it back down. The volume's still low; it's less than average compared to this volume. Okay, so then it comes back down a second time. The volume's still low. So that tells you that there's no real selling pressure. You've even got a test after that, an attempted bottom reversal, so you can see the market's still strong. It's likely to go up. This is another test here. Down bar, volume is less than the previous two. Okay, it's a good sign after. That would have been on really bad news. I don't know what that would have been on, but that would have been August. That could have been on the 10th anniversary of the 1987 stock market crash, where they were probably talking about it. And probably trying to say, oh, you know, this is going to happen, that's going to happen, you know, and of course, you know, the herd panic, as they do, and or there was some sort of bad news. Sure, if you went to the 16th of August 2007, you'd find some sort of bad news in there at some point, something. But look at the result. You've got down bar, close on the high. How can that be weakness if it's closed on the high? You know, how can that be weakness? Especially if it's on bad news. I mean, if the news is that bad, why is it closing on the high? You know, like I said, I don't know what it was. I should have looked it up really, but I didn't. But down bar closing.
Patriotic.
Yeah. Well, I'm not a U.S. citizen, but you know, and this is the Dow, so I'm kind of impartial. But it does affect me, you know, because those winds do blow west or east, as it were. So yeah, so close on the high volume. Next bar is quite high volume, but then you've got a test. So that will tell you that any high volume on this up bar has been discounted because it's a test, and you've got this in the background. So you can see that the market's now primed for an up move, not a down move. And as you can see, prices cannot really go down very far. You have weak bars. I mean, that's a weak bar. It's a low volume up bar, but you know that's no real excessive volume on up bars, you see. So you couldn't really say that there was any weakness there because there's no excessive volume to the upside. So therefore, you cannot say that there is weakness there. There's strength in the market, and then it's tested, it's tested, it's tested, and it's probably tested there. That's quite a strong bar. Started out as a down bar, closes as an up bar. I wouldn't personally short on that, simply because you got this followed by testing, and you got this and all that. You got all that. Market's unlikely to go down very far.
Is selling climax just stopping volume on steroids?
Yeah, something like that. Selling climax is when the news is really, really bad, and all the herd panic at once. You know, they're literally panicking because they think they're going to see lower prices, and their stock portfolios are going to get wiped out. That's probably what they think. Or another scenario could be that any money that's managed by brokerage houses or funds could be closing out deliberately so that they can accumulate for their own in-house funds, because that does happen as well. You know, there's a lot of really nasty stories that I could begin to tell you about, you know, where people have been wiped out because they've had money with managed funds, and then the broker actually trades against those funds. They take the profits of their own funds, dump the stock on their managed funds by the public, and then the public's left holding the bag, and then the company's own funds make a profit at a loss to the public. I mean, if you've ever read any of Richard Ney's books, you'll see that, I think it was Merrill Lynch once had an advert that, you know, if you were a block trader and you wanted a market to distribute to, they had something like 3,000 clients, but they could then get their sales engine into, you know, for a fee, they would distribute that stock amongst their clients without putting it on the open market if you were a big block trader. Because don't forget, if you're a block trader, you can't just dump 100, 200 million shares onto the market. You just put the prices down against your own selling. So, you know, there are all these tricks that people, you know, like Good News, you know, all these tricks up their sleeves to wrong foot you.
Sorry.
Yeah, go on.
What do you, after that sign of strength, what are you looking for?
After that,
what do you look to go long when you're going to actually place your trade? Right there?
that, right there. And that is within 5 bars. And I've always said you should see a test or confirmation of strength after 5 bars. If you don't see it within 5 bars, you know, the odds are dropping. You know, the odds are dropping. So I like to see it 1, 2, 3, you got that within 3 bars, that's quite good. You got another one there at 5, but look, the result is that after that, you know, you're going to be looking at a slight loss before it comes back your way. So if I see a shakeout, I'm looking for it within 5 bars, and then I say, yep, the move is happening. So, any questions on that? Otherwise, we're 6 minutes ahead of our break. So it's up to you.
I know you've talked about it before, but
Yeah.
tell us again why on that big bar there.
Yeah.
It's got the green, you know, the sign of strength.
That one, yeah.
Yes. Why would you reason not to go along on that one? Because you'd be afraid
It'd be risky.
that
Look
the
at the
next one
volume.
would be down.
Yeah, but yeah, okay. So supposing the next bar was down bar and you went long on this one, you'd be immediately under pressure, wouldn't you? You know. That's why you don't buy on high volume or low volume, but you don't buy on high volume up bars or down bars. You always wait for the result of that. Okay.
You're talking about the news and what they'll do contrary to what we want to do. It reminds me of my son-in-law. He knows in trading. He said, Dad, if you listen to the news, it's going this way. Get with it.
Right.
Yeah.
Thanks, Jeff.
Now I'm going to do the opposite of what you just told me. And you probably do money. In fact, you know, I would love to get maybe five guys or, you know, women or whatever, who consistently make losses. Get them in front of a chart, and then you do the opposite. You'd make a fortune, even if you shared out the profits with those people. You know, because they represent the herd. You know, and they can have any technical analysis they want. They'll probably invariably be wrong. And don't forget that your emotions are your own worst enemy. I mean, this is not just about chart reading. This is really about psychology as well. You know, it's the psychology behind it all. And they know all these tricks that they can get you. All these tricks.
Sorry to keep
don't carry on, because this is what I want.
I want to ask you something about the psychology. If you go to Principle 5, that chart,
Right.
And principle 8, there's just an underlying idea that I'd like to ask you about. Principle 5 first, actually. So after the basically a breakout on high volume, okay, you go up, and then there's a up thrust where the indicator, there's a little red triangle there on top. Little red rectangle.
Yeah, I know.
The up thrust.
Well, it's not really an up thrust, because an up thrust, it should be much higher and wider.
Okay, so what my question is that for the uninformed person, they see that, and then the following bar, there's no real response to that, what looks like an evidently sign of weakness.
Yeah, but what if you got a test in the background?
No, I understand. So you have strength in the background,
Yeah.
and then you have what would seem to be, to uninformed people, a sign of a weakness, an up thrust type bar. It went up, it broke out above the top, it came back down. Those people are at a loss. The following bar, nothing. There's no follow through. That somehow tells you that there's strength there, because there's strength in the background.
Yeah.
There's a fake move. People go short on that perhaps, and then the next move, the next bar is down but low volume. There's
Yeah.
no follow through, narrow range,
Yeah.
and that tells you. And then the following bar is up. Now you could. It looks to me like that's a very strong sign to go long. And
Okay, so what I say to you is, you're taking that bar into isolation. Where's your weakness in the background?
no, that's correct. That you
So
want
you
to go
wouldn't.
long.
So that's not an up thrust, is it? Because
No, it's
for an
not.
up thrust, you've got to have weakness, not strength in the background. And you've got an accumulation phase back here. You've got a widespread up push through a previous top. It's then tested. There's no weakness there.
Right.
Okay, so there's a low volume up bar there. Okay, that could be just that the market's just resting. Okay, and then you've got, it tries to go up, and then comes back down, and then it comes down, closes off the low on an even narrower spread. To be honest, I mean, I know why this indicator's appeared, because it's probably looking for high volume in the background, and it's up bar close on the low, and next bar is down. But you've got to be real careful. That should be a wide spread down closing on the low, and it isn't. See how that's a wide spread down closing on the low, the next bar struggles to go up.
Right.
Okay, you don't have that here. You've got down bar on a narrow spread, close slightly off the low, and the volume is still low. It's not less than the previous two, but it is still low. Next bar is a wide spread up. You'd have to ignore that.
Right.
You'd have to say, right, okay, putting the picture together, we've got an accumulation phase in the background, we've got an old top which is broken through on a wide spread up. Okay, there will be shorts up there, support resistance traders. Right, they'll all be under pressure. It's then tested. Okay, then it just rests basically. Comes down, narrow spread, and then mark it up. It should be tested again after this bar as well, at some point within 5. Okay, and you want to do? Are you happy with that?
Yeah, no. I agree exactly with what you said. What I'm trying to understand is if you look at things the way I'm trying to describe, that when you have an obvious, what looks to be like an obvious sign for someone else who doesn't know what they're doing,
Right. Okay.
and then there's no follow through to that is a very strong sign of strength.
Yep.
Following that, and in chart number 8, principle 8, you have the same thing. You have a sign of strength because of that high volume shakeout over there.
Yep.
Big sign of strength, and then you have some up thrusts throughout the chart. You see those type of
Yeah, but you don't. They're not up thrust.
no, but what
Yeah.
looks like to someone who doesn't know what they're
Uninformed.
doing.
Yeah.
And then all of a sudden that bar where the line is all to the right more. Yeah,
Yeah.
right there.
Yeah.
That's a beautiful move because you have that supposed weak bar right before it, and then there's really no response to that. And everyone who tried to go short on that
Yeah.
got suckered, and then it goes up from there.
But you wouldn't be, right? Because you can read
I
it.
would, you're right. But I'm trying to understand, do you look at it that way, the way I'm describing, or is that something that, I'm making up?
No, but you see the thing is when you've got strength in the background, you ignore any potential weak bars because you've got strength, not weakness.
Right.
See, and that's why it's so important that
Right.
you don't just take these bars in isolation, that you have to look in the background. And this is why I keep going over it, because it's so important that you understand that and that you remember that. It's, I would imagine, I don't know if it's easy to go home and forget about it, but you really can't afford to forget about this stuff.
Right.
Because look, I mean, it's made a low, right? And it's not making any lower lows, is it?
Right.
The market's not going any lower. So therefore, There's no selling pressure in the market there. So when you see something like that, followed by something like that,
Time to go long.
you know, but this is what puts the whole thing together.
So just because there's a top tail does not mean it's an upthrust.
That's not an upthrust because you've got strength, not weakness. An upthrust is only valid when you've got weakness in the background, not strength, you see?
What would possibly that trade guide or indicator be above that bar there?
I'm fairly certain that probably would say an upthrust, but this is why you've got to know the principles, and then you've got to get better than the software.
Can you go back to number 5 again? So
Number
that's
five?
a question that maybe software related. I'm guessing, I haven't seen the code, of course, but that is a high volume up bar, no question, with the cursor on it. But the fact that it's punching through a high from way back there, the software probably isn't looking that far back to know
No,
that
it's
that's
probably
a
not.
sign of
And it probably wouldn't know about this
strength,
either.
not a sign of weakness.
Yeah, but this is what brings, that's why you have that bar up there, is because of this, and this accumulation phase. And what I've also noticed,
And then it wants to jump over the
Yeah.
people who are accumulated on that island.
well, the market's so strong that they've pushed it up on a widespread up and through as quick as they can in order to lock all these people who are liable to sell.
Yeah.
They don't want these people liable to sell, so they mark it up quick to try and encourage them not to sell.
The software doesn't see that, it just
No,
sees high volume
that's
up bar
right,
as weak.
yeah.
And so it therefore marks that big upthrust.
But you,
No, it's not.
knowing how to read these principles, will be able to say, well, that one's genuine or it's not genuine. You see? Yeah, I mean, you will always get bearish indicators in an uptrend. You'll always do that. And this is why it's important to be able to read the bars, especially the trend. You can see the trend is up. See, even here you've got down bars on those volume into this. You know, it's been accumulated. So when you see a widespread up, that's why you have to wait for the result. And the result is that it's tested. That's why you would ignore that. That should be a really widespread up, closing on the low, because that's stop loss catching, which you don't have. Because it's narrow, you ignore it. And you've got the strength in the background, not the weakness. So you can say, you know, you can look at it and you say, well, where's the weakness? I'm going to ignore that. And you'd be wise to ignore that because the next bar is down, narrow spread, widespread up. I mean, if you went short on there, you'd be under real pressure there on that one. So that's why you've got to be able to read the background. That's why it's so important. And that's why I keep going over it all.